Okay, so the big piece of information that is the talk of the town that is dictating markets today is the CPI. We didn't talk about the CPI yesterday. Why didn't we talk about the CPI yesterday? Because we had absolutely no idea where it was going to come in, just like basically everybody else. So it was almost pointless to talk about the CPI. We are long yields going up, and despite that, we were still up better than all the major indices, including the Russell. And we have over 20% cash. So, what are we seeing? What are we doing? Well, now we're staying steady. Look at yields. Yields are doing nothing. First thing in the morning, right after we got the CPI, they fell quite a bit. And then very quickly thereafter, at least the 20-year, came right back up to the flat line, continued to push and stay. The 10-year auction was strong. I believe it was like the third highest indirect bidders on record. That's a lot of foreign buyers. There's clearly some demand for it. But despite the third highest indirect bidders on record and a less hot than expected CPI print, yields basically were flat. As a matter of fact, the 20-year and the 30-year were up on the day. I find that quite interesting because, inflation's supposed to come down to 2% in the long run. Well, forget all that talk. Forget what you're hearing in the mainstream media because this is where the opportunity is, I think. I think yields are going up and people just seem to be ignoring the Fed. The thing is, don't fight the Fed, okay? People are saying, CPI is lower, we can buy stocks because peak inflation, Fed's going to cut. They're going to start now easing. They're not saying that. They're saying that absolutely nowhere. I'm not buying into it. Maybe I'm wrong, but the Fed has talked about how they want to communicate effectively. They brought the market down starting in January through communication. So I think their communication dictates where their policy is going to go, and they're not trying to mislead us. They're not trying to spook the public markets into thinking one thing and then shock the public markets into being totally wrong in some way. I don't think that's what they're doing. I think they're actually trying to help us, guide us, and provide us with information. That's what they're doing. And they're talking very clearly. Kashkari, we are far, far, far away from being done with inflation, aka hiking rates, aka quantitative tightening. He didn't say far away. He didn't say far, far away. He said far, far, far away. Okay, this is a Fed that cares a lot about the communication. Three fars. Not one, not two, 3 fars. We are 3 fars away from being done with inflation. So when the spread between the Fed funds rate and just one additional minimal hike, the smallest hike possible, 25 basis points, when the spread between the Fed funds rate with one additional hike and the 10-year is basically zero, it doesn't make any sense. They're not doing just one hike. I think maybe you can get a little crazy and look into far, far, far as 3 more hikes. Probably not 25 basis points at the next one. Clearly, they're not happy even with 8.5% inflation. They want to see inflation have multiple, instances of coming down. We heard Bullard say specifically, one tick down isn't going to matter. That's all we got today. All we got today was a tick down, okay? Nothing. So, I'm long stocks. I like. Disney was one of my largest positions. It's doing well. I'm not going to sell it, okay? It can pull back a little bit. I'm not going to freak out. But on days like today, I'm going to consider trimming a little bit. I had these Jumia calls that made a lot of money today. They had some time left on them. But I decided to take that and just put some extra cash in the pile. Just put a little extra cash in the pile. Tomorrow if we have another green day, I don't know, maybe I'll find something. Maybe I'll take a few shares of Disney out. Maybe I'll do something there. Maybe I'll look at something else. Take a little bit of cash, put it back in the pile. That's what I'm doing. Yields are going up as far as I'm concerned. I've laid out all the reasons why that is very clear. The market is having this day today because they're expecting yields not to go up. Well, yields are flat. That was the initial reaction. First thing in the morning, we saw the yields come down very strong and then pop back up. Beach ball effect. Get ready because there's a wide dispersion here. The market is seemingly thinking that the Fed is not going to tighten, okay? They're getting all worked up about 8.5% inflation. 8.5% inflation is tremendously high. We had that number in May or March, I believe, and it was a totally different outlook. People were saying, the May number was peak inflation. Well, then June was 9.1. And then all of a sudden they moved the goalpost. That didn't make sense. There's a couple, weird dispersions going on. It doesn't make any sense. There's still companies that are doing very well, like Disney. Obviously, good numbers. Doesn't make sense to not own that or sell it. So we're not going to sell it. But yields also don't make sense either. So the market's down. I'm not really directly short the market. I was short individual stocks. I'm just short. They miss earnings. I cover. But do have a small, just to, transparency, I do have a small S&P 500 put, very small, like basically doesn't matter. I think I have an ARC put. I know I have an ARC put as well. Not that big. The hedge that makes sense to have here is yields. So, yields going up. That might take stocks down. It might not. I don't know. But it might. So, I'm having some cash. And I have some plays on yields going up. And we'll see what happens. That's today's video. And until next time, peace out.